In the previous class, we have discussed some principles of insurance. They are principle of utmost good faith, principle of causa proxima or principle of proximate cause, principle of insurable interest, principle of indemnity, principle of subrogation. These principles have been discussed in detail in previous class. Today, in this class, we are going to discuss remaining two principles of insurance. Principle of contribution. This is to be discussed now. Yes. Contribution principle applies when the insured takes more than one insurance policy for the same subject matter. This principle applies to the insured when the insured takes more than one insurance policy for the same subject matter. It states that same thing as in the principle of indemnity. The insured cannot make a profit by claiming the loss of one subject matter from different policies or companies. Yes, now we shall see an example. A property worth rupees 5 lakh is insured with company A for 3 lakhs. The property worth is 5 lakhs and it is insured for 3 lakhs only. And with company B for 1 lakhs. Same property is insured at two companies. One is for 3 lakhs and another is for 1 lakh. The owner, in case of damage to the property for 3 lakhs, can claim the full amount from company A. Yes, it is damaged for 5 lakhs. Now, the property of worth of 3 lakhs is damaged and can claim the full amount from A. But then he cannot claim any amount from the company B because the damage is 3 lakhs. Insured for, even it is for 5 lakhs, make a policy for 3 lakhs. The worth is for 5 lakhs. Policy took for 3 lakhs and the damage is happened for 3 lakhs. So he can claim only of that 3 lakhs full amount from company A. But he cannot claim a single pie from the company B. Now, company A can claim the proportional amount reimbursed value from company B. Yes, the proportionate amount. He took a policy of 1 lakh. So that proportionate amount can be claimed by the A company from B company. In brief, the person who insured the property cannot claim more than 3 lakhs. And he cannot get the profit by doing many policies on the same property. Yes. Shall move for the next principle. Principle of loss minimization. Loss minimization. This principle says that as an owner, it is obligatory on part of the insurer to take necessary steps to minimize the loss to the insured property. The insured one should take all the measures to minimize the loss to the property at the time of risk, at the time of contingent incidents, unexpected incidents. Yes, if we are there, we shall try to minimize. And if we are not there, we are informed by some other, either watchman or neighbors or passers. They noticed and informed that owner. And in such situations, the owner should take all the possible measures to minimize the loss to the insured property. He must try. If he doesn't try, what happens? He has something intention to make loss to the insurer. So always the insured or the owner of the insured property or substance or subject matter must take the necessary action to minimize the loss. Yes, we shall take an example. Yes, if a fire breaks out in your factory, you should take reasonable steps to put out the fire. You can't just stand back and allow the fire to burn down the factory, because you know that the insurance company will compensate for it. You know, if any incidents are happened, if any accidents or any fires are happened, you know that the amount will be paid by the insurance company. You know, perfectly know. And at the same time, you must try to stop it with possible measures, with possible methods, not beyond that, not beyond the possible method. Your possible extent, you must try to stop such kind of incidents, to stop such kind of losses. If you don't stop, if you don't act within the possible circumstances, you have an intention to make loss to the insurer. So, in such situations, the insurer object to pay the loss to you because you have not taken any measures to stop that incident. So they simply reject your compensation based on these grounds. So, with this, we have seen 7 principles of insurance. Now, we shall see the types of insurance. There are 2 broad categories of insurance. One is life insurance, the other is general insurance. Life insurance. The insurance policy whereby the policyholder insured can ensure financial freedom for their family members after the risk or disability or maturity. So the insurance policy whereby the policyholder can ensure the financial freedom, financial support, security to their family members after the disability or after the risk or to him or her on the maturity date. So it gives the financial security, freedom, liberation, support to the family members. There are 2 incidents, occurrences. There are 3 occurrences. One is maturity after the completion of the term, and another one is disability, and the third one is at the time of risk or death. So it offers financial compensation in 3 circumstances. Yes. While purchasing the insurance policy, the insured either pay the lump sum amount or makes periodic payments in the form of premium to the insurer. Yes. Premiums may be in lump sum or in periodic payments. In lump sum means at the time of taking the insurance policy, the insured pay the lump sum amount, the single premium, generally we call it as the single premium policies. We pay in single time, one time, and the insurer will give the insurance to that person. So it may be in lump sum or in single premium, or it may be the periodic payments. Periodic payments. So in exchange for the payment of the premiums, in exchange of which the insurer promises to pay an assured sum to the family or to the insured one. The insurer promises to the insured, the family members or the policyholder, whoever he may be, ensure the financial protection. In the event of risk occurrence or disability occurrence or at the time of maturity. So there are three options for the payment of the insurance amount. One is disability and risk and the maturity. Depending upon the coverage, life insurance can be classified into the below mentioned types. As we have seen, there are two types of insurance in the broader sense. One is life insurance, the other is general insurance. In life insurance, there are other types which are mentioned below. See, the term insurance. The insurance is applicable to the certain term, not the whole life. Certain time. For example, if we take a policy for 5 years, risk can be borne by the insurer is 5 years. If the policy is taken for 20 years, the insurance company give the assurance to pay the compensation for 20 years if anything has happened in between the starting point of the policy taking to the maturity or the risk time. It gives life coverage for a specific time period, for specific term. That is called as a term insurance. Whole life insurance. This insurance offers life cover for the risk cover for the whole life of an individual. It covers insurance for entire life of the insured or individual or policy holder. In this insurance, the insured expect the protection to their family members because it won't be paid in his lifetime. After his life, the financial compensation, the financial security will be paid after his life. So, it is done only for the family members' purpose. endowment policy. Endowment policy. The premiums which are paid by the policyholders are portioned into two parts. One is for the death benefit, the other is for the investment purpose. So that the investment bits collected from the various policy holders are pooled, gathered, and is and invest them in other profit earning companies in the shares, debentures, or anything else. In the investment instruments, the some portion of the premiums will be invested by the insurance company. Next, money back policy. In the name itself, it shows that money back on policy in intervals. A certain percentage of the sum assured is paid to the policyholder in intervals throughout the term. Throughout the term as survival benefit. Yes. Example, A took a policy for 20 years, money back policy took for 20 years, and as for the terms and conditions, the money will be paid back after 5 years, every 5 years, certain percentage of amount. So after completion of the 5 years term, money will be paid to the policy holder. Again after 5 years, some amount. Like that, the amount will be paid, money will be paid back on policy to the policy holder by the insurance company. Next, pension plans. Pension plans. Also called as the retirement plans. This is a fusion of insurance and investment. A portion from the premiums is directed towards the retirement corpus, which is paid as lump sum or monthly payment after the retirement of the insured. So, the premiums which are collected on the pension plans will be directed to the retirement corpus, and at the time of the retirement, there are two options to the policyholder. It is to be made option in the beginning of the policy. That is, one is payment of lump sum amount after the attaining the age of retirement, and the other is monthly payment system. So option is a choice of the insured person, policyholder. So that insurance, that pension will be paid lump sum, either lump sum or monthly payments. Child plans. Child plans provides financial aid for children of policyholders throughout their lives. It protects it gives the protection for the needs of the children, financial needs of the children with this policy. That may be health expenditure needs of the children, educational needs of the children, or any other required needs of the children to be dignif- to be with dignity in the society. Child plans are taken by the parents for their well-being of the children, for their children's well-being. ULIPs, unit linked insurance plans. Same as endowment plans, a part of the premiums goes towards the death benefit while the remaining goes towards the mutual fund investments. Units Units means units of the mutual funds, parts of the mutual funds. So some portion of the amount is invested in the for the death benefit, and the remaining part goes towards the mutual fund investments by the insurance company. At the final payment or the maturity payment, sometimes it fluctuates. Because these types of plans are purely linked to the fluctuations in the stock market. Fluctuations in the stock market. So, if the prices of the units are increased as we expect, as we expect, if they are increased, much returns will be available and paid to the policyholders. In abnormal conditions, adversary conditions, if the units price are decreased, the return on ULIPs will be less if we compare to the normal situations. So this maturity amount is based on the prices of the units which are concerned to the investments. Now we shall go for the general insurance. Everything apart from life, other than life, can be insured under general insurance. Very simple. In easy terms, general insurance is the insurance which can be done other than lives. Very simple. We can do the insurance on any goods or any properties, but not on lives of the people. So everything apart from life can be insured under general insurance. It offers financial compensation on any loss other than death. Any loss other than death. It covers other than death. General insurance covers the loss or damages caused to all the assets and liabilities. Okay. We have the machinery in our plant, in our farm. Yes. Our machinery is damaged. It is an asset, it is damaged. If it is insured prior to the damage, yes, we can claim the amount for reinstallation of the machinery. The value equivalent to it. For example, we have insured for 5 lakhs, but the machinery is 10 lakhs. Only we can claim for 5 lakhs rupees. The value of the machinery is 5 lakh. Even though the value of the machinery is 10 lakhs, only we have done the insurance on 5 lakhs. So, it covers assets and also liabilities. How? How is it possible on liabilities? Z took a loan, house loan from SBI. Z is capable to pay the loan EMIs. Even though he is capable, generally, the SBI takes the policy on home. If he doesn't pay that amount due to that policy, he can claim the amount of EMIs. So, SBI, by accepting the insured one, generally, policy, insurance policy will be taken on the loan amount, that is liability. On liability, the policy is taken. After some time, he has gone into bankruptcy. He is unable to pay the loan EMIs. In such situations, the policy which was taken by the SBI for the loan coverage, which we have taken the policy from, which company we have taken the policy, we can claim that EMI from that company. So, general insurance covers the loss or damages caused to all the assets and liabilities. The insurance company promises to pay the assured sum to cover loss related to the vehicle, medical treatment, fire, theft, or even financial problems during the travel. It covers all these things. It covers the vehicle, medical treatments, fires, theft, or even financial problems during the travel. General insurance can cover almost anything and everything, but the 5 key types of insurance available under it are major insurances are health insurance. Health insurance. It covers the cost of medical care. It covers the expenditure of the medical. If we have the health insurance policy, if any medical problems are arisen, simply we go to the hospitals which are registered on that policy, on that insurance companies, and we can get the service of medical, and the amount will be paid by the insurer because we pay the premium for that insurance, so we have the right to claim such kind of expenditure. Next, fire insurance. Fire insurance gives coverage for damages caused to goods or property due to fire. Due to fire. Yes. We shall take an example. There are 1,000 computers in our warehouse. They are manufactured and stored for selling. Unexpectedly, 20 computers robbed by the thieves. 20 computers. But we took the policy for fire. Can we claim that amount on them? No, because we have taken the policy for fire and the theft is happened, so it doesn't cover the theft. So fire insurance amount, the amount cannot be claimed through the fire insurance. So fire insurance gives coverage for the damages caused to goods and property due to fire. And the same computers are affected with a short circuit and burnt the 20 computers. In such situations, the insurer will pay the amount. Travel insurance. Travel insurance compensates the financial liabilities arising out of non-medical or medical emergencies during travel within the country or abroad. Within the country or abroad, if any financial liabilities are arisen, and if we take travel policy, we can meet all the expenses. We can claim all the expenses from the insurer. The travel may be in the country or abroad. Next, motor insurance. It offers financial protection to motor vehicles from damages due to accidents, fire, theft, or natural calamities. So the motors can be damaged with the accidents, fire, theft, or natural calamities. In such situations, motor insurance pay the compensation to such damaged vehicles. The vehicles may be it may be small or big, from bike to the procliners, movers. Okay, now let us take an example. We have purchased a bike 2 days back and we parked in a parking area in front of a hotel. We parked there. We took the insurance policy on it. Unexpectedly, another big vehicle hit our bike and it was damaged. 70% is damaged. In such situations, we can claim the another bike for the damages because it's a new vehicle and it was damaged 70%. The insurer provides you a vehicle. But at the same time, that insurer claim the amount which caused the accident, that is third party. And fire. If any fire is happened to our vehicle and it is burnt, insurance can be covered with the motor insurance policy. We parked at one place and it was theft by robbers or thieves. In such situations, the motor vehicle will be provided as for the value of that present value. The value at the time of theft is assessed the team of the insurance company, and is valued and paid to the insured. Are the natural calamities. Natural calamities. If due to the natural calamities, if anything is damaged to the vehicles, that will be paid by the insurance company. Yes, okay. Now we shall see one example. In Vishakhapatnam, due to cyclone, nearly 10,000 vehicles are damaged. It is an example. 10,000 vehicles are damaged due to cyclone. So, does the insurance company pay the amount to 10,000 vehicles? It is a big amount. 10,000 vehicles. Does it pay? Yes. It should pay that compensation to all the vehicles, because the premiums which are collected from the various vehicle owners all over the India pooled into one. From that pooled amount, the compensation will be paid. So, it is occurred in one place. So, the company will pay to such kind of damages. Home insurance. This compensates the damage caused to home due to man-made disasters or natural calamities or other threats. In the recent years, most of the house owners are doing the insurance on their homes. If any damage, if any damage is happened, to the home, that may be the man-made or natural, or other threats. If it is damaged, house is damaged, home is damaged. In such situations, 1 minute, wait for, yes. So it is damaged with the man-made, either man-made or natural calamities or any other threats. If we have taken the policy on home, we have taken the insurance policy on home, the damages or losses caused to the home will be paid to the house owner, because the policy was taken on such home. So Nowadays, it is also become a common phenomenon to every house owner. So today in this class, some two principles covered and the types of insurance are covered. In life insurance are broadly classified into two categories: life insurance, general insurance. In life insurance, term insurance, whole life insurance, endowment insurance or policy, money back policy, pension policy, child plans, unit linked insurance plans. And in general insurance, other than lives, are classified home insurance, fire insurance, travel insurance, motor insurance, home insurance. So, with this, I hope that you have understood the maximum extent regarding the types, the principles of insurance, and the types of insurance. With this, I conclude this class. Thank you all.